S. Naren joins us, CIO with ICICI Prudential AMC. Naren, good morning. Thank you for joining us. So Naren, I guess two things which over the years I've realized you should never commit to at the beginning of the year, which is never make New Year resolutions and never predict the market, because they both go wrong. You break your resolutions and you never get the market call right. So what do you want to start with?
I think I first want to wish all of you and all the viewers a very happy new year. That certainly I can't go wrong on. So I think clearly that's how I want to start it.
Okay, thank you for your wishes, but will it be a good year for investors, or will 2019 be a year where markets will get earning projections wrong, politics will have a larger role when it comes to economics, and the market mood will not remain volatile, but it will remain very choppy and unpredictable?
See, when you look at 2018 January and 2019 January, clearly our view is that 2019 January there is more margin of safety than what was there in 2018 January. In 2018 January, most of the market looked fully valued. Most of the small cap and mid caps looked overvalued. And whereas when you start 2019, what you find is that 80% of the stocks are at least fairly valued, and maybe a small set of stocks could be considered overvalued. So I think from a mutual fund point of view, which is a long-term investor point of view, 2019 January is a much better time than 2018 January. Having said that, basically what happens is an election year coupled with US Fed's last few tightenings makes for a volatile year, and therefore again from the point of view of mutual fund, it becomes very easy to make it a SIP year or an STP year at this point of time. So I think it's very different from 2018. Actually in 2018 we believed that as you went down the market cap curve, there were more risks, and now actually there are much more stock picking potentials, and you have a much better environment for stock pickers now, although it was believed last year was the best year for stock picking, but frankly except the 4 or 5 mega caps, everything else actually went down through the year. So 2019 is a more interesting year for all of us. It's possibly equally likely to be equally volatile, but I would call it a year to put money and accumulate money in equities at this point of time. So that's why I like 2019 over 2018 clearly as we speak.
Okay, Naren, once again, a very happy new year to you and your entire team at ICICI Pru. But you know, start of 2018 and actually all through 2018, the call was stick with large caps, or at best, if you want to diversify your portfolio, you know, going in for multi-caps would be a good idea. But do you think the time has now come wherein we will see maybe the risk-reward ratio favor mid-caps a little bit more? Has the time now come for that long-awaited mid and small cap recovery, or do you think you're safer in 2019 also to skew your portfolio towards large caps?
So actually I believe that you are safer in stock picking now rather than in capitalization weightage, because if you look at large caps, there are clearly 10 stocks which do look overvalued at this point of time. On the other hand, similarly in mid and small caps also I could find stocks which look overvalued. Having said that, today there is a number of stocks which have corrected 30-40% in small caps, 20% or so in mid caps, which have all become much more reasonable. So I would say 2019 is stock picking time rather than deciding which caps to go. And where we have changed, I would say, is like, you know, if you looked at where we were, what are the calls we got wrong? We didn't recognize that oil could come down from 85 to 53. And that actually completely changed the outlook towards sectors like infrastructure or banking kind of sectors, because these sectors clearly benefit with lower interest rates, and also the fact that banking companies do get some treasury profits as well. So I would say clearly sectors like banking and infrastructure are the areas where reasonably positive change has happened. through the year, particularly with the fall in oil.
Fair enough. Do you think that 2019 would spell specifically great news for the financial sector, and especially, you know, for the beaten down names? Is there an opportunity to generate alpha there, Naren?
I think clearly if I look at where banks are at this point of time, I think banks are in the best situation which I've seen in the last 5-6 years. Their cost of borrowing is not going up, their lending rates are going up. The NPL cycle in corporate India is about to get over, and a lot of provisioning has been built for that NPL cycle. So I think banks are in a extremely good phase. Compared after 2015, I think I would say we are in the, possibly from a fundamental point of view, we are in the best phase for banks, and that need not be true for all other parts of the financial services industry, but banks are the biggest. They have been the people who have contributed, if you ask me, to much lower earnings growth in the last 6 to 7 years, and I think they are going to give a cyclical benefit over the next 2 years in earnings, which should help overall earnings of large caps pretty significantly in the next 2 years. So I would be really much more positive on banks than as I was, particularly the corporate focused banks rather than the retail banks, because the retail banks have had a good run over the last 6 to 7 years.
Naren, we've got your outlook on risk and valuations, very important parameters for investors and for fund managers. But I would like to throw in my second important element, which is that how long can we ignore the selling in US markets? We saw a similar factor, Naren, at play in 2007. When the world discovered a problem called subprime, US markets started correcting, and emerging markets like India, they outperformed for good 6 months. And the financial community termed a very famous word called decoupling. But in 2008, everyone realized that there is nothing called decoupling. Decoupling may last in the short term, but when a large market like US market, it corrects in a relentless manner, then everything will come down. Is that the biggest risk for 2019, that the correction in US markets has started? It is largely because of economic reasons, and if the correction multiplies more, we could be looking at serious downside somewhere in 2019?
So I don't know, people do make use of valuations as a way of saying that the US market is extremely overvalued. When I look at valuations of, let's say, some of the consumer names, they don't look very high. And I would say that it was a valuation which was a problem. I think clearly I would say that the US market required a correction. But I'm not so worried about US markets the way the market seems to worry about. I think US economy is possibly one of the best economies at this point of time. And I don't see the risk of a big fall in US. See, the conditions that existed in 2007 in the form of extra leverage with people and various other problems in the financial system, I don't see that kind of a situation at this point of time. I got a chance to meet with some good global economists, and they say, barring corporates to some extent, I don't think there is any evidence of extremely high leverage. So I'm basically not worried about a big fall in the markets or something like that. That doesn't mean that, you know, markets are headed one way upward or something like that, because there is no fear still in India or many of the markets. The second is that you look at the EMs. There was a cycle from 2009 to 18, which I would call the US cycle. And I would even call it the US tech cycle, because you can look at companies like GE over the last 10 years and say that nothing has happened in US. In 10 years, GE has gone down so significantly. So I would say that it's the US tech cycle which looks certainly more advanced. I think emerging markets have not had a bull run for a long period of time. I'm sure that in the last 10 years, particularly on a dollar basis, the kind of underperformance that emerging markets have had is significant. So I'm not in that extremely worried camp or something like that. The challenge at this point of time is how much positive returns can you make rather than expecting negative returns or -20 or something like that. Because in a country like India, corporate papers give you 8, 9, 10% on a 3-year basis. So the benchmark return that you have to get on corporate papers, above corporate papers for equity to deliver, that is the challenge you are having. And which is one of the reasons what we have been always doing is marketing debt funds through the year, and contrary to what people think, 2018 was a year that most debt funds did well, and even today corporate papers are giving you good interest rates. So I would say the challenge is how much does equity outperform debt, and that's the challenge rather than worrying too much about equities per se.
Okay, but Naren, you know, considering that bond yields are sub 7.5%, what is the kind of return that we can expect from debt funds?
See, actually, if you look at corporate spreads in the post-September period has gone up substantially. And while, for example, you have a situation where 10-year G-Sec yields have gone down, many of the corporate papers on the 3-year side has actually been giving you good spreads. So I would say that, you know, this entire thing, people look at 10-year yields and say interest rates are down. I can assure you most of the corporates are actually borrowing at higher rates, except maybe a few AAA names. I think most of them are borrowing at higher rates than what they were borrowing 6 months back. And so that's why I would say debt is remaining an interesting asset class at this point of time, particularly shorter duration debt is on the corporate side is turning out to be a reasonable interesting asset class.
Naren, give us your sense on how much can the Indian market withstand global pressures into 2019? I mean, how much of that is something that you worry about, you know, adding to the fact that there would be election event related volatility that may also peg us back?
See, 2019 is going to be a volatile year. That's the reason we have been calling it the SIP year. So I don't think volatility is going to be any lower in 2019 relative to 2018. But you know, the way we always look at it is whether is oil going down along with the markets, or is oil going up and the markets are going down. I think India is very vulnerable even today to oil going up and markets going down together. If you have a scenario like what you saw in October, December, where markets fell and oil also fell, I think India will always remain an outperforming market, because $1 drop in oil improves India's current account deficit by $1.5 billion or so. So it becomes a powerful positive for India. So I would say that more than global markets, I'll watch oil, and I would be worried if oil started to go back to 75 and 80. If there is global volatility, do I worry so much? No, I don't worry about it. Having said that, do we expect 2019 to be volatile? The answer is yes. Do we have appropriate strategies within our mutual fund to help make money in volatility? The answer is yes, both through products like SAP, STPs, and through products like Balanced Advantage as a category, equity savings as a category, etc. So I would say that we are not really worried about global volatility. Clearly, elections are important, US is important. And as I keep telling people, there's no point in asking fund managers on elections, they know nothing. So I think that is the way I look at it. And but I would say 2019 is an interesting year to invest, much more than 2018. And that is the challenge I have in explaining, because in 2018, while everything was looking possibly better, the valuations of many of the small and mid caps were also much higher than where they are today.
Naren, I'll talk about your NFO in a minute right now, but you know, I'd like to draw your attention to what we've been calling as the most crowded and the most expensive trade, whether it is staples or whether it are, you know, some of those niche consumer companies. Now every year we start the year with an assumption that cyclicals will make a comeback, capacity utilization will pick up, and the economic activity in the real economy will pick up. But by the end of the year, we come back to a different conclusion, which is that consumer is where the romance is, consumer is where the buying power is, and consumer is where the safety is. We've seen that in 2016, 17 and 18. Why do you think 2019 will be different?
It better be, because for 3 years we have lost in consumer stocks on a relative basis, because along with earnings going up, price to earnings have also been going up. So the price to earnings of most consumer names today are much higher than what they were 3 years back. I continue to think, if you look at it, we are all trained to think that when you don't have a big capex into a sector, finally at the end of the period you will have a situation where earnings will catch up. If you look at metal stocks from the bottoms of 2015, they've had a meaningful rally. Although 2018 was not a good year, but 2015 to 18 has been pretty good for metal stocks. And I see something similar happening on the cyclical side. Because if you've had 10 years where there's been virtually no one who started putting up a power plant, I think eventually demand for power will catch up. And if you look at, so that's why I'm really not worried about a cyclical recovery. And as long as I'm a mutual fund investor, I want to invest for the long term. The longer it takes time for something to play out, the more opportunity I have to get new investors in. So that's a positive I get from this whole process, and that's why for me it's reasonable. If I'm a trader and I've kept trading these cyclicals, it would have been a problem, but I don't see any big worry on the long term at this point of time. Having said that, consumer names have baffled us. We've gone wrong, frankly, and I would say that we are not the kind of people, we always look for other cheaper alternatives, and barring 2008, in earlier years, we did manage to find stocks which outperformed them, but 2018 was a year where it did not work. And having said that, I believe 2019 is a year where again our stock picking models would certainly work.
Let's talk about your NFO. NFO is a different NFO. It is an NFO which is coming under the category special situation. Now, in an open-ended scheme where you're trying to, raise money, and when your stocks will be declared on a monthly basis, will this kind of an approach work? And what is the differentiated proposition for this NFO?
See, actually, if you look at the global mutual fund industry, many of them have very large special situation funds. And there are fund managers like Anthony Bolton who have actually built their entire fame on the basis of special situations. I believe that Indian markets have moved to a model where special situation investing is likely to work. It requires a large active fund management industry, because it is the large active fund management industry which is likely to provide stocks to the special situation fund when a problem happens. So if there is a problem in quality of any product due to which all the active funds start to selling that share, it's actually the buyer of that share who will be able to get it cheap. Why did special situation investing have good scope in the long run? Clearly because it's one of the techniques to buy cheap, and if you manage to buy cheap, you got one part of the investment argument correct, because you're not buying costly. And the way the world is shaping up, there are enough problems which come up in different ways. You have quality control, you have strikes, you have trade wars, you have government policy, you have other kind of sanctions. And I believe that continuously we are going to be in this phase where, and that too you're through with the quantitative easing part of the monetary policy in many parts of the world. So I think we are in a phase where we should be able to identify special situations, and that special situation investing allows you to buy cheap. And I felt if there is such a big global category which has done well in many parts of the world, I don't see why it should not do well in India, and that's how we looked at it. And I think that we would be able to buy cheap. It's part of our natural style of investing, which is to look for problems And I believe here you can create a portfolio which is only based on buying into special situations. And the important thing which people have to recognize is it's not necessary that you have to buy the sector in trouble. You could buy an unintended beneficiary. So if you look at when the bank NPL cycle happened many years ago, the biggest gainers were actually NBFCs and the retail banks. So out of that special situation, it was not the one with the trouble you buy. You sometimes buy unintended beneficiaries, and there also gives you a lot of investment opportunity. I think what is the challenge here? The challenge is investors have to have a 3 to 5 year outlook. If people have a 3-month outlook and look at this kind of a strategy, I don't think it's likely to work. But I think on a 3 to 5 year kind of a strategy, it's certainly one of the strategies which I have high active share and can deliver longer term returns which are good.
So Naren, closing comments. I'm quite excited about this proposition what you're offering. It's a very unique proposition, something very different, something which is core of your thesis, where you like to do contra investing. So my last and the follow-up question would be, special situations don't last forever. They are very periodic, like stress in telecom, or the sell-off in NBFCs, or the overvaluation which is there in some of the so-called consumer names. Do you think a special situation fund is not like an SIP product? It is somewhere you need to invest bulk, because if you follow an SIP model, you're following a disciplined approach, and in a special situation, the disciplined approach may not work.
So I think basically what has happened, if you look at the last 10 years, there have been wide divergences between the way sector like consumer or some of the retail banks have done and what the rest of the market has done. I think what special situation investing requires is wider divergence of valuations due to problems that have happened in specific sectors. I think that's one of the reasons. If you look at 10-year returns of many of the names, you'll see wide divergences today between one set of names and the other set of names. That's the reason why from a lump sum point of view also it looks interesting. But we always believe a category like special situation does lend itself to systematic investment through SIP, STBs as well. But today it lends itself to interesting opportunities primarily because the last 10 years have not been normal. We had one of the most hated bull markets, and in that hated bull markets there are names like consumers, retail banks and a few others which have done exceptionally well, and the rest have done badly because of their own problems. So I think from a starting point of view, we seem to be in an interesting position. Having said that, I think clearly the challenge for a category like special situation is that people have to have a 3 to 5 year orientation and not a 3-month orientation. That's the challenge we have in communication, and that's how we hope investors today are matured enough to look for such high active share products with a 3 to 5 year view.
Okay. Naren, we leave it at that. Thanks very much for taking out the time. First day of 2019. Very auspicious.
Thank you.
Helping our viewers understand your investment philosophy for the coming year. Wish you the very best.